So for the past 25 years, we've seen valuations of farm property across the prairies and particularly Alberta continually increase in value. And of course, with those high valuations comes high tax obligations. And when you're talking to several million dollars of asset value, you're talking several $100,000 of tax obligations. And the purpose of rollover provisions is being able to try to pass assets across or down on a tax deferred basis. And in doing so, you're trying to prevent those unintended consequences. And what I mean by that is unintended tax consequences. Because again, without knowing the nuances of rollover provisions, you can create yourself a situation where you're paying a lot of tax on an asset you are not selling. And that is why working with a financial planner who knows and understands the nuances of the ag tax world can ensure that they provide that forward looking planning that keeps more of those potential tax dollars in your pocket versus Revenue Canada. Hi, my name is Ryan, one of the financial planners and advisors here with Pellegrini Financial in Red Deer, Alberta. So when it comes down to the rollover provisions and passing property down, the idea is to be able to move assets on a tax deferred basis. And this is something that can be done while living or in someone's estate. And now the primary objectives on that or reasons are first and foremost, succession planning. We have farming children who are taking over the operation. Somewhere along the line, they're happy to farm it, but they also want to own the asset. Other reasons to pass, property down is for income splitting purposes, whether it's between spouses or whether it's between children, non-farming or farming. And the idea being that, okay, you can take that revenue from the farm property and be able to split it out between multiple tax filings. Lastly, I think one of the other reasons for rollover provisions is to be able to pass farmland down to the next generation in order to multiply the lifetime capital gain exemption. And now there is a difference between passing land while living versus an estate in order to use lifetime capital gain exemption. So if you pass it while living, each child will have a 36-month or 3-year waiting period before they can sell the property and actually use the lifetime capital gain exemption. If you receive it in an estate, it's no issue. You can sell right away. They can use their exemption. And again, try to make it a tax-free sale on that asset. They don't have that waiting period. Each child can use that lifetime capital gain exemption immediately and use it to their advantage. Qualification of farmland comes into two basic sets of rules. First being that for land acquired prior to June 17, 1987, you've had to own the farm property for at least 5 years and actively farmed it for at least 5 years. For land acquired after June 17, 1987, you've had to actively own the property for at least 2 years, actively farmed it for 2 years, and your gross farm revenue had to exceed all other sources of income. So there is an income test. Now, the value of the 2 years is the fact that those 2 years you can pick and choose. They don't have to be back to back. You can pick and choose what years work best in your situation to ensure the farm property qualifies. So now that we know and understand how land qualifies, rollover rules actually apply another layer on top of all of that. And that rule is essentially where 50% of the asset had to be actively used in the business of farming. So what do I mean by that? Well, if I've owned the farmland for the past 40 years, let's assume that I actively farmed it for the first 20, and now I've been passively renting it for the next 20. I'm right at that 50% mark of actively using the farm property in my active farm business. If I rent it for one more year, I am now offside for rollover provisions. I've used that farm property for less than 50% in the active business. And so that is where it's critical and important to understand the additional rules of rollover provisions, and also understanding that this applies to every individual piece of land on its own, right? We've talked about this in the past, where every individual piece of land on its own has to qualify on its own, including rollover provisions. And we've worked with farm families and actively today to identify for them each property that they own, when they acquired it, how long they farmed it, how long they rented it for, and what year does that property have to roll over to the next generation. Now, where do rollovers work exactly? Well, it is precisely down the family line, immediate family only. What I mean by that is parents to children, grandparents to grandchildren perhaps, right? But you cannot go sideways. We cannot pass property from between siblings or to aunts and uncles or to cousins. It is only down the family line. Now, the one thing you cannot do is be able to roll property back up. What I mean by that is from child to parent or from grandchild to grandparent. With the exception of death, if someone dies at the wrong time or out of order, yes, you can roll property back up, but otherwise it cannot be done on a tax deferred basis. Here's where it gets messy. Rollover provisions are basically internal family agreements, right? It is up and down the family line. And so a lot of the times it's a verbal agreement, maybe a handshake deal. Maybe there's some paper that kind of describes what they're trying to do and accomplish or intent. Unfortunately, it's not very clear. And as a whole, you have kind of two governing bodies over top of these rollover provisions. One is land titles, and the other is CRA. Well, land titles, you can add and remove names to title, whatever you want. They'll just request whatever supporting any documentation they need to make the change, and they'll make the change. They don't really care, is the intent for beneficial interest and avoiding probate? Is it meant to be direct ownership in the property, right? At the end of the day, land titles does not care if it's a tax disposition. They certainly don't care if there's any tax obligations. CRA does, however, care if it's a tax disposition. They do care if it's a tax obligation, and they'll obviously want some payment. And that's where working with professional advisors or financial planners who know and understand the nuances of rollover provisions and ag tax can ensure that more of those potential tax dollars are staying in your pocket versus giving them to Revenue Canada. Provides a measurable amount of value in ensuring that you're following the right steps, you're enacting whatever transfers or transitions at the proper times, and you're documenting it in a clear fashion so everyone knows and understands the purpose and intent. We hope you enjoyed this video. Like it, subscribe, and follow us for more ag tax videos from Pellegrini Financial.